No.
Yeah, I do the lazy shower guy thing sometimes. So I'll I'll wash my face in the sink and I'll wash my hair with water
Yeah.
and then I'll dry it out and then and then it does what I want it to do.
I'm more of a before sleep shower guy.
Before sleep, shower guy. Yeah, I don't know. I can't do that, man. My hair gets
Yeah,
all
people are
messed up.
different that way.
Yeah, I can't do that. I'd love to do that, but I can't. All right, brother. Well, thanks for joining me. I really, I was happy to see Templeview. I've seen you guys around a lot. I've never placed a loan with you. So I was hoping to kind of get a better idea. I saw that you guys do a lot of ground up construction stuff, and that's a big gap for us. Ground up construction is difficult. A lot of the lenders that I use on fix and flips, their primary thing is fix and flips, and then their secondary thing is ground up construction. And so they're always a little bit more timid on that end. So I'd love to hear your thoughts on that and kind of, if you could just give me a breakdown of what you guys are doing over there, that'd be awesome, man.
I mean, funny that you say that because we're exactly the same. So
Okay.
our bread and butter, our niche is fix and flip.
Yep.
Ground up construction is secondary,
Hmm.
but the product is really good. And because we don't, do many of them, we're a little bit more flexible when it comes to them. I will tell you this. I'll tell you one thing though, John. I'm a straight shooter. I'm brutally honest. I'm very transparent in the process. I hate to oversell and under deliver. So I have a completely different business model than most of my coworkers,
Hmm.
but it seems to work better that way
Yeah.
in my experience here. So I mean that's why I'm kind of, you almost like segued me into being like, oh, he might be perfect because these other lenders have fix and flip as a priority, but actually I'm
Sure.
the same way.
Sure.
But like we still do them and we still like them. Um, Let me give you an example of what they're like. So I would say for the most part, a lot of lenders, whatever LTC they're at, I think most lenders they will do the LTC based off of the construction budget.
Hmm.
Correct me if I'm wrong. So if the bit say the budget's a million and they're at an 85 LTC, they're like an 85 LTC lender. I believe the client has to do if a draw is like 100K, they have to do like they'll get 85,000 reimbursed,
Yeah.
whereas the other 15% they're responsible for.
Yep.
I think that's how most do it. We do it differently where 100% of the budget always has to be accounted for and covered. So we like kind of overprotect ourselves and it just kind of makes our capital partners happier. It makes our loans a little bit more, safe and reliable. So we actually, although we're 90% actually, which is the highest in the country, I think, we actually do go 100% of the budget. So if a client does 100K worth of work, they're getting 100K, not 85K,
Hmm.
right? The other big thing that we do is we do full interest reserves.
Hmm.
That does sometimes come up with other lenders on like refinances. We do it on purchases and refinances. We're going to roll in all the interest payments. Now, this is a big kicker. On fix and flip loans, it's full Dutch. 9 out of 10 times it's okay, but there's that one client that does not like that. On ground up construction is non-Dutch. I'm not
You're
gonna
gonna have
sit.
to clear for me what Dutch means, because that's a
Oh,
new term for me.
oh wow. Okay, so Dutch is
Yeah.
like paying interest on interest, right? So
Oh, okay, okay.
yeah,
Full Dutch. Where does the word term Dutch come from?
I'm not sure, but it's always been in our industry. So like, look at
That's
it this
crazy.
way.
I've been in
Yeah,
the industry. I've never heard the term Dutch.
really.
You learn every day. Oh,
Oh wow.
absolutely.
I mean, yeah, I like that. I like the fact that we learn things every day, for
Hmm.
real.
It is real. And that's the
But
cool
like
thing. You got to humble yourself and always be willing to ask questions because new terms
always
come up
willing to
all the
learn.
time.
Yeah. But yeah, I mean, basically, it's interest on interest, meaning like, if you were a borrower and you took out a loan to do a investment property, right? They're going to charge you interest off of on day one off of your base loan amount for the acquisition, right? Plus whatever you've drawn on rehab funds,
Hmm.
right? So it's like if you start off with $100,000 budget and you've only drawn up to $10,000, your interest on that rehab is not that much right now, right? It starts to accrue and get bigger as your project gets more and more complete, right? We unfortunately do it from since we roll in all those payments from the beginning,
Right.
and if your budget's like kind of large, you're paying interest on that whole thing from day one.
Yep.
So if you break it down, brass tacks, like I'm not trying to call people penny pinchers, but the smart people that do, really calculate the numbers and they really truly care, they'll see that, financially they're paying a little bit more compared to the lenders that don't do this full Dutch
Yep.
method,
Yep.
right?
But it's hardly anything. I mean, we do the same thing at our firm. It's not a huge sum
It is.
considering the amount of money they'll be making. At least
Yeah.
in my
Yeah.
experience, it's like, who cares? Of anything, it's incentivizing you to get the deal done quicker.
Exactly. That's how we
So
sell
just
it.
get it
Yeah.
done. Don't sit around. We don't, and that's the incentive with the lender too. And here's the thing with the lender, the reason why they do that is because guess what? You have to reserve that money and not lend it to somebody else. So why shouldn't you be earning interest on that money that you've reserved for the rehab? Does that make sense? So when you fund the deal, you fund for the purchase, right? That's gone. That goes to the seller. And then you escrow the rehab money.
Yeah.
Why shouldn't the investor be earning money on the escrow money? Why should it just be sitting earning no interest? It doesn't make sense to me. You're reserving that money and you can't lend that to somebody else. So
Yeah.
it always makes sense for me. The full Dutch, which is this term that you just brought up, it should always be full Dutch. From an investor's point of view, why would I put money aside and not be
Well,
earning any interest on
not
that?
the investor's point of view, but yeah, the lender's point of view,
Well, the
absolutely.
lending,
Yeah.
the
Yeah.
lender being the investor,
True, true, exactly.
right?
Yeah. But I mean, like 9 out of 10 times the borrower, they don't care. You'll
Right.
get that one person that really questions it.
Right.
And then they realize, oh wait, yeah, I guess I do pay a little bit more, but for these larger loans, I don't want to pay $20,000 a month interest only payments. Like
Mhm.
I have loans that are like say 2-year loans, interest payments are $20,000 a month. They don't got to make any of that. It's all built into the total loan amount. Like it's pretty
Mhm.
awesome,
Mhm.
right? So back to why that's relevant is that on the ground up construction loans, we do non-Dutch. So
Mhm.
like it's the interest is accruing off of what's currently drawn.
Right.
However, we do it really weird, and please don't ask me how we do this, but the big thing is how do we as a lender cover full interest reserves for the whole term of the loan if we don't know where the client's at with the rehab, right? So it sounds really like it sounds like it doesn't make any sense, but it does. We do like a percentage of the full budget up front, and then like I don't know, I don't even know how we do it, but yeah, we roll in full interest reserves for the entire term, but it's on a non-Dutch interest accruing method. It's kind of neat,
Sure.
right?
Sure.
Yeah.
Yeah. No, that's nice. And you say interest reserve, so you're going to be having those payments reserved already in the escrow account. You guys build that into the loan. Is that what you're saying? You build the
Yeah.
payments into the loan. Does the borrower still have to make payments?
No,
No. Okay. So it's all already kind of drawn.
just like the rehab funds, same way.
Well, that's nice. That's nice.
Yeah.
Okay. And so with the ground up construction, how many draws do you guys allow?
I mean, as many because we get draw fees.
Mhm.
I think depending on the size of the project, there's got to be like I think the exact number is if we have a draw approaching 200K for
Mhm.
one draw, we have to have like sets of eyes on them, like extra set of layers and reviews. But I mean, as long as everything's kosher and everything's done the right way, I mean, the draws are fine. But
Right.
basically, because we don't really like draws being over 200 grand. I mean, you imagine depending on the size of the project, it's going to be like let's say 20 to 25% per draw, right?
Mhm. What about property types?
Single family and then 2 to 4 unit multifamily,
Okay, gotcha. So
residential only.
1 to 4 units, residential only, and that's
Yep.
nationwide, right?
No, so almost. We got off the top of my head, North and South Dakota, Vermont, and Delaware that
Okay.
we don't do.
That's everybody else is right there
Everybody
with
else.
you. So,
But I know if the circumstances, so okay, so we're not the biggest lender, but we're not the smallest lender, and we're not a balance sheet lender. So we got good capital. If there is a really good scenario with strong compensating factors, a strong sponsor, borrower, right?
sure.
We'll take a look at it. Like I know some
Okay.
of my coworkers have done loans in Delaware, even though we don't do Delaware,
Right, right,
right?
right.
So it depends.
Right. Okay. And what about so I know the interest reserve is going to be built in those payments, but you're talking about ideally you want to be making draws at a 25% per draw, ideally, which makes sense.
Ideally,
I
yeah.
mean, that would keep the costs low. You only do 3 or 4 of those.
Yeah.
But what kind of reserves do you want to see in the borrower's bank account uh, to start the loan?
So we don't need that upfront on most of our products, but we will in some situations, right? Are we going to focus specifically on ground up construction, or do you want me to segue to other products?
Let's talk about ground up for now, and then if we want
Okay.
to segue, we'll do that.
So ground up construction, or GUC, we don't require any sets of reserves at all from the borrower. I could ask for it for compensating factors, like if some guy's only done 5 projects and they're say all of them were like 500K new builds, and he's trying to level up and build a $2 million house. Normally, as a lender, we're going to be like, oh, we kind of want to see experience building larger homes first. However, if this borrower has liquidity north of 1 million, maybe we'll take that shot. Like
Right,
we'll
right.
do
As a compensating, but
as a
you don't
compensating,
require to see reserves.
not for ground
In,
up construction loans.
and really,
Yeah.
well, how they,
You're-
how do you know they're going to be able to pay for the initial, I don't know, foundation lay or whatever before their draws?
Well, why would they close on a high interest rate loan, right?
Right. Interesting. Well, that's
Yeah,
really nice. Reserves are very common, like DSCR loans. People want to see
exactly.
reserves, and that's a surprise. Actually, that's a really good feature right there because my idea whenever I hear somebody who doesn't have reserves, I just say, well, hey man, do you have any credit cards? Like cover the payments with your credit. I mean, if you don't have reserves, use your credit not to do a cash advance to show reserves, but use your credit cards to start the initial work on the property, then you request the draw. So yeah, at least get some work going. But I'm curious how, if someone literally had no reserves, how they're going to finance the start of that ground up construction before their first draw.
I mean, our thought process is that they wouldn't be doing this if they didn't have the money, right?
Okay.
But there's no
Okay.
reason for us to ask for it.
Okay. Okay.
Yeah.
That's sweet, man. Hey, man, that makes it easier for us to place the loans, more origination.
Yeah. So even like our fix and flip, we don't need it. We need it if the client wants to like opt out of those interest reserves. Like, oh, if they don't want their payments rolled in baked into the loan, will show us that you have the money to pay for these anyways, right?
Right.
But it's
Right.
never
Right.
like an upfront requirement for our products, except like you said, DSCR.
That sounds
Yeah.
good. How about the loan amount? What's your
Min-
maximum loan amount? So like, you got the Beverly Hills ones that are like 20, $30 million
yeah,
sometimes. So
that's out of
where do you
our
where do you
out of our
tap it out?
4 million.
4 million. Okay. Small
Yeah,
balance, regular fix and
all
flip
about
stuff. Okay. That's good. That's good.
like
Okay.
100K to 4 million.
100K minimum.
Yeah.
Okay. Do you have any city restrictions? A lot of lenders don't want to lend in Detroit or Chicago.
Yep. Yep. Those
Yep.
two. So we actually used to have it at Chicago specifically. We've widened it to Cook County completely.
Yep.
Actually, no. Let me go back. The state of Illinois, right? So now it went back again. So we have like Illinois, Baltimore, Maryland, Detroit, Atlanta. What else? I'm just doing it off the top of my head. Those might be it for this like
Right.
specific ones.
Right.
But
And in
yeah,
my
those have a five
experience,
percent.
in my experience, lenders tend to bounce. They'll bounce like on a quarterly basis. Sometimes they'll change policy. Say,
Yeah.
hey, we're deciding to kind of start working in Illinois or some with a compensating factor like you're mentioning. Maybe you're willing to pull the trigger. Kind of depends. Tell me about it.
Yeah. Do you want to
Okay.
know specifically like what states? I pulled it up.
Sure. Yeah, lay it up.
I mean, I guess specifically it's Atlanta, Baltimore, New York City, and Philly.
Yep.
And then I'm gonna broaden it out. We broadened it out to Essex County, Union County in Jersey,
Mm-hmm.
Nassau and Suffolk County in New York, just like the
Mm-hmm.
Hamptons and stuff.
Mm-hmm.
Cuyahoga County, Ohio, and then real quick the states: Alabama, Alaska, Hawaii, Indiana, Illinois, Louisiana, and Mississippi.
No
So those
ground
are the
up is
ones. Oh no, those are the ones with the geographic like leverage reductions.
required. Okay, gotcha. So special issues.
Not
Or
special issues, but yeah, just like instead of our max 75%
right,
leverage loans, they'll be at 70%, like a 5% drop.
right. It's equity protection. Those are more volatile areas for
Yes.
various reasons. That makes sense. Okay, what else should we know about the construction loan? I mean, we haven't talked about interest rates. I tend to pull away from interest rates because those
No,
change so
I like
frequently.
to say that. I like to say it right away.
Yeah, yeah. Generally, I mean, well, I mean, generally, I'm assuming they're the regular rates. So why don't you just drop them on us, and I'll just say the date real quick so I don't forget when this was released. May 19th, 2023. What are your rates right now?
So for ground up construction, we only I have to back up for a second. So
Sure,
we have four experience tiers:
sure.
bronze, silver, gold, and platinum. Yeah, bronze is 0 to 1 properties under your belt, silver 2 through 4, gold 5 through 9, platinum 10 plus.
Okay, give me that range.
Ground up construction can only be only gold and platinum borrowers can qualify for ground up construction.
Got it.
Whereas like a fix and flip client can start up as a newbie, right? A new investor with 0 properties. But construction is you got to be 5 plus properties, right? At gold, which is the 5 to 9 properties, the rate is 12.5% base.
Mm-hmm,
And then the origination is 2.5 points base.
mm-hmm, mm-hmm.
And then platinum is 12 and 2. So a drop of 50 basis points on both sides.
Okay, got it. How do you build your brokers into those construction deals?
Um, it's completely separate to our fees, so it's just added on top.
Okay, throw it on top. No yield spread, right?
No yield spread.
Okay. Can you tell me about their role? Do you guys have any kind of correspondent lending attached to Templeview, or is it Templeview is always going to show as the lender of record? Broker comes in, just brokering the deal as a normal broker.
Both. So we have a retail broker channel where like if you brokered me a deal, you work with me or Templeview directly, you're the broker on record and you get paid on the HUD.
Uh huh.
There are B2B correspondent, third party originator channel where if you did, you could get approved for table funding,
Mm-hmm.
where then you would show up, as a lender, you would essentially fund a deal. Or if you don't get approved for table funding, it's still kind of done the same way as a retail broker, where
What
you'd
are
be
the
broker on record.
requirements? What are the requirements to be a table funder?
So table funder and just being in third party origination in general, I believe, and I stepped away from it. I was too busy in retail, but I believe you have to have a track record of like 2 million plus a month. There's a process to sign up. The broker, the principal broker, and the partners have to, quote unquote, apply, provide, financials, a track record. Kind of go through that process to become a B2B broker.
What benefit is there to becoming a table funder with Templeview? Is there any financial benefit aside
Pricing.
from? Yeah, go ahead.
So I don't know this because I don't do it anymore, but
Sure.
pricing is, I think we charge the broker something below our base pricing, right? So that 12 and 2 I had mentioned, it would be
Mhm.
lower than that. That we would charge you lower. So whatever you get on top of that, whatever you can upsell, it goes straight to you.
Got it. So there's a yield spread in essence built
Not
in.
on the back end though, only at time of origination. I know
Right.
some of the products do have a yield spread, I believe. But for the most part, you just, if we charge, say, 10 and if the base is 10 and 1 and you as the third party originator is charging 11 and 2, like anything over is yours.
Right, right, right.
Yeah.
Anything over is yours. Can you tell me about those payouts? I know you're not doing it anymore, handling that, but do they get paid out monthly on that, or is that a lump sum at closing? If they sell it at an 11 and 13
No,
versus
so
the
that
10
it'll be like at closing,
at
at time of
closing.
origination.
Great. So
Yeah.
they'll earn all that interest right away with no waiting period. That's fantastic. That's great. But you need experience. Some lenders don't require experience, some do. So in this case, you need a little bit more experience. That's fantastic. Would they still get a rep like you to hold their hand while I, in a way, make sure that have that ninja in the background playing
No,
the
yeah.
spy game for
There would be,
Temple
yeah,
View?
there would be someone to help out.
That's good. That's good. Okay. Well, let's pivot on over to the fix and flips, and then you can actually you can tell me all the other programs that you might have. So if you have a debt service program, love to hear about it. Give me a breakdown of your other programs if you don't mind.
So fix and flip, obviously we're gonna tell you guys that that's our bread and butter. Um, you know, payments built into the loan. We do rehab draws as advanced and reimbursement. So if you come in with experience, like, and I had mentioned it before, the tiers, if you're gold or platinum, you have the option to opt in for advanced rehab draws. Basically meaning, after closing, we'll give you an advancement of
Right.
soft cost for like 20% of your budget, and you can use that to begin your work instead of using credit cards, as you mentioned
Right.
before.
Right.
Payments rolled in again with that and the advanced draws. Some cash strapped borrowers are in a better liquidity position because of that.
Mm-hmm.
Our leverages are still pretty good, up to 90% LTV and 90% LTC, and then 75% ARV. But basically, just like any other fix and flip loan,
What's the purchase LTV?
90 up to
90?
90.
Up to
Yeah.
90? What's the lowest tier? Say you're inexperienced. How about no experience? Do they have to own their primary?
We'd like to see in most situations some kind of home ownership. I
Mm-hmm.
think the numbers like within the past 3 years, some kind of home ownership.
Some sort of ownership. Okay,
Yeah,
got it. And let's just say they have no experience aside from some sort of ownership, bottom tier credit and everything. What's the lowest purchase LTV that you're hitting people up with their terrible experience, terrible FICO? Up to
80%.
standards, 80%. Okay, that's not too bad. That's not too bad.
Minimum
What's
FICO.
your lowest FICO requirement?
We said at the same exact time, 660.
660. Okay, not bad. If you don't have a 660, it's pretty bad. Just so you guys
Yeah,
know, I'd say 660, like that's covering a huge amount of people.
yeah.
Uh, okay, right on. Any DSCR products beyond your fix and flip and your commercial, or excuse me, and your ground up? Do you have any 30 years?
Yeah, so we do the DSCR, debt service coverage ratio loans for residential 1 to 4 units. We do purchase, cash out, and rate and term refis.
Oh, you got it all.
Yeah.
Well, why would someone go with one of your guys' debt service products versus the other guys?
Oh, this is good. I had to sell someone on this the other day. So I think there's like 3 or 4 good lenders all doing DSCR right now. I'm out of the running. Look, at Templeview's out of the running with short-term rentals because we
Hmm.
don't do short-term rentals. But for say long-term rentals, I mean, we should more or less be in the same ballpark price-wise. But of course, there might be one of them that might be like 25 bips, you know, an eighth price, like, better priced, right? However, I got someone on board with me with a rate that's 25 bips higher from us due to like my ability to help the borrower through the process and communicate with them. So I mean, when you ask me what makes us any different besides price, I mean, I would just say like the ability to close a loan. I've had people always tell me at certain, specific lender it might take 60 days, there's minimal contact, can't get an update for days, weeks, whatever. So usually I sell myself on my like ability to manage the file.
Hmm.
But price wise, it should everyone right now that's doing DSCR should be kind of more or less around the same.
Right, right, right. What's your
Yeah.
debt service requirement?
So
LTV or
the
not
best
LTV? Yeah, debt service.
optimally we want 1.2 plus.
Okay.
We can still close certain loans at 1.0 minimum.
Is that so? Say they're purchasing a vacant property, however, are you basing that debt service on the rent in the area that the
Yeah.
appraiser gave you? Okay,
On
gotcha.
the off the 10, yeah, off the 1007 market rent.
Got it. Got it. Okay, great. What about refinances? Same store. Can you refinance a vacant property, or does it have to have somebody in there debt servicing?
So optimally, preferably we want it to be leased and same thing, 1.2 plus. But if it's unleased, it's just there's a price adjustment. And I think in most scenarios for cash out, we require it to be leased, but sometimes we'll take an exception,
Got it.
depending on
Got
the
it.
area, the borrower, the market, the collateral.
Okay. You're you're doing the full suite of products. Is there a way for someone to seamlessly get a fix and flip, the Burr strategy, fix and flip, you know, get it rented and then refinance? Could that be one loan, or is it got to be two, three separate loans, whatever,
It'll,
however
it'll
it's
be the it'll be the two,
okay.
the purchase and rehab, and then the takeout, the DSCR takeout.
Okay. Okay. Anything else I should know that I haven't asked?
I mean, not really. I would just say, you know, again, I don't know if this is more informational or if you're like truly like asking to get more info from me to like do deals together, but 1 to 4 unit, no more than 4 million. I mean, my term should be pretty good. Like it should be one or two of your final options mostly every single time.
You pushing a
So
30-year product on your DSCR?
Yeah, it's only 30 arm or fixed. Mainly, we mainly like to do fixed, but yeah, the DSCR is only 30 years or
Got
30
it.
year.
Got it. Got it. Okay. Well, I think you've answered most of my questions. With the brokers working with you, is there any sort of like broker protections? So
So,
when is the broker protected on a deal? So no other broker swipes it or whatever.
well, it depends, right? So we use Salesforce as our CRM. So internally, you'd be always kind of protected. Like, let's say you bring in a deal, and because you're charging 2 points, the borrower's like, "Oh, let me be sneaky and try to call in through the
Right.
main line and try to get a loan officer that doesn't know this broker," right?
Right.
That's better protected because we have Salesforce and a CRM. Because let's say you bring me a loan, I'd put you in under, your name, and then that person would be under your name and so forth. But that doesn't stop a client from, say, switching brokers. I've had that happen where, like, let's say you bring me the deal, I charge you 10 and 1, you charge 1, that's 10 and 2, right? And then this other broker, that client shops, and this other broker is like, "Oh, I can get you 10 and 1, but I only charge 0.5." We technically can't stop that, right? But we could stop, a borrower trying to circumvent a specific broker
Right.
like, yeah, we can stop that, but we can't
Right.
stop someone from shopping brokers.
Right. 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 No, that makes sense.
Yeah.
What if, well, even if the loan, let's say they bought the appraisal, they've started the process, they're halfway through. Could they bounce brokers?
I mean, technically they could, right, as a
Oof.
consumer.
Yep.
But I've had that call before where I had to hop on the phone with the borrower and the broker that's potentially getting screwed over. I mean, I had that call and just be like, "Hey, listen, we're all in this business together. You can't really do that. It's kind of like not good practice." And, most of the time it's taken well. And, "Oh, I'm sorry, it was an honest mistake," even though it wasn't.
Yep.
But I mean, honestly, we can't really stop that. I think because again, we also have to, I don't know. So, if it's that far in the process, I think we would have to step in and tell the bar we just can't do it,
Yep. Yep. I
right?
would
So it
assume so.
depends how far in the process it is.
Yeah. They
Like
signed a term sheet. Hmm.
if there's like an appraisal back and this file's been underwritten, they're just trying to screw over the broker for half a point at the last minute. No, we're not going to do that. We're going to protect the broker.
Yep. Yep. That's fair. That makes
But
sense because
if they're shopping term sheets though in the beginning phase stages, that's something I don't think we can stop.
right. Right. No, absolutely. That makes sense.
Yeah.
Okay. Well, how do we get a hold of you, Jay or Joe?
You got my direct number, right?
Yep. I got your direct number. I got your email address. Do you have any marketing material for our brokers?
First I'd have to get you approved. If you want me to, I can send you the email for our broker package.
Yep.
It has like 5 or 6 requirements. Not too easy, not too bad. We do a soft credit pull and a background check. I mean, you're
Okay.
in the financial services industry, so you should be fine. But of
Yep.
course, we sometimes get those one-off brokers that, it looks really bad.
Right.
But you're in the financial services industry, so I imagine there's gonna be no issues.
Right. 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 No, it's fantastic. All
Yeah.
right, Joe. I think that's all I got for you, man. Is there anything else? What do you think's going to happen here over the next 12 months? Everybody's a little bit shaky, man. So, what do you think? What have you been seeing, and what do you think's going to happen? Are we going to be all right?
I mean, we've been you and I have been doing the same thing. We've been feeling like this for the past 2 years, right?
Yeah. Yep.
Yeah. So I mean, we're just kind of all going with the flow,
Yep.
right?
Yep.
We do what we can. Yeah.
My philosophy is strike while the iron's hot. So,
Exactly.
lenders are lending. You're a broker. Smash as many deals out as you can, and if things slow down, that's just more of a reason to work harder.
Yeah.
All right, brother. Well, thank you so much, Joe. I appreciate your time, man. And I'll be send me the broker package. I'm gonna get into your system, and then we're gonna get you hooked up with my brokers that are working under us.
Okay. Sounds good, John.
All right, brother.
All right. Take
Peace.
care.
Take care,
Bye.
man. Bye bye.